Good morning, ladies and gentlemen. Good morning, good morning, good morning. Let me start off by asking a question, all right? How many of you just, with this trading thing, you go from one thing to the next all the time, and you're trying to figure out what's going on and how to be profitable. I'm going to give you a tidbit this morning. The best way to be profitable is to find something that fits your personality and that has an edge, and you trade your edge, and you do it over and over again. I heard a wise man once say, once you find something that works, it's a rinse and repeatable process. You do it over and over and over and over and over and over again. So you'll get to kind of see what we do over and over and over and over and over again today. So let's get it started by checking out our longer time frame charts. We'll go to the quarterly first. Same old, right? We got a bullish outside bar last month. This month we're working on inside bar. So this month is kind of choppy right now. Up, but still choppy. Monthly chart, same old. Got a downtrend with a potential ABC pattern to go down. Weekly chart, trend is up and it's trying to push up. So we have to kind of see where that lands. As far as the daily is concerned, she's right there on the brink of that resistance up top. So we really don't know what she's going to do. And in addition to that, it's an inside day. So got to keep all of those things into consideration. So with that being said, let's get to our intraday charts. And we had an opportunity here potentially, but we're just getting on. So that opportunity doesn't count there, but that's what we look for. It gave us everything we wanted to see. Um, so yeah, so that being said, we'll get Ronald Jones to kind of queue up and let us know what the news
The
is.
news.
Yes, sir.
All right. So at 8:30 we had a red folder Empire State Manufacturing Index, and at 11 a.m. we have a yellow folder FOMC member Waller speaks, and that's it.
What time is FOMC Wallace and what color folder? I didn't hear it.
That is a yellow folder at 11 a.m.
8:11 a.m. Okay, cool. All right, well, let's wait on her to rock and roll and see what's going on. Let's wait on her to rock and roll and see what's going on here, ladies and gentlemen. Um, I don't have a bias today, one way or the other. Kind of just let the market tell us because right now we're on, if you look at it from a long-term perspective, you have a congestion or confluence area right here. So I will go ahead and redraw my lines so that you can see where areas of potential support and resistance may lie. So let's get the horizontal line here going. And it's right in about that area. Okay. Uh, and that's why she bounced off of that low right there. Because if you look all the way to the right here, you can see what price just keeps hitting, keeps hitting. So we got to wait and see what it does. in that particular situation there as well. And I'll draw those two lines for now and wait and see what it gives us. In the interim, what we'll do is we will queue up the how to scale for max profits class. I'm in the process of giving. We'll play part 1 and 2 today. And then I'll record part 3 this week, and that'll be the last part for this particular lesson or particular class. So we'll do that and go from there. Are there any questions for me? Any comments?
No, sir.
Can you flush your 300 screen, please?
Absolutely.
Congested though. I can see it from the last, unless this time frame is off. Yeah, this time frame looks off.
So trying to erase that. Hold on.
Oh, here we go. Give the video on your call.
On you. We ready.
All right, part 1.
All right.
Scaling market.
Good evening, everybody. Good evening. Today we're going to talk about the secret to profitability, right? So I talk about price floor analysis. That's the secret. The secret to being profitable consistently is price floor analysis. Price floor analysis utilizes multiple time frames in order for you to see what's going on in the overall market so that you can get into the market at an opportune time where the market is now going in your favor. I'm going to prove it to you. I took a trade today and I'm going to show it to you and I'm going to show you what it looks like, right? I took a trade today, as you can see here, and I entered the trade 3 times. I entered it once at 52, another one at 57, and another one at 61. Okay, so I entered those 3 times and I exited all of my trades. I'm sorry, I entered it at 52, 50, 57, 50, and 62, 50, and exited all of the contracts at 61. So that's what I did. And let me show you where the secret lies. Right? I got into this trade on my 2 larger time frames. I had long-term and short-term momentum going in my favor, as well as the trend. I'll highlight it for you so that you can see it. If you look,
a lot of people tell us, you finally explained trading to me in a way I could understand. Then they start.
Use the little commercial, ladies and gentlemen.
here I have long-term and short-term momentum. Here. And I have trend signified by my moving averages here. So, and you can see the same thing over here. My long-term and short-term momentum are all in my favor. My trend is in my favor. So I literally have a trend within a trend trade. And it's the exact same thing that I've shown in my previous videos when I've shown this is how we trade, and I'm going to show it to you. So if you're looking at this chart, then you'll see where I have price go from a lower low to a lower high to a higher low to a higher high to a higher low to a higher high. I have an uptrend right there. And then we have A, B, C correction. So you have A, B, C in your correction. And then I get in once I know that I'm confirmed to go up. And I know that I'm confirmed to go up here. And where I enter at, I enter in here, end up making approximately like 12 points on that trade. Now, if you learn to do that, you will be profitable more times than not. And every now and again, you'll catch one that goes so much in your favor that it's almost ridiculous. Now, let me show you where I did not catch this trade later on in the day, because I typically don't trade this late in the day. But I didn't catch this trade the way I wanted to. So let's look at it, right? And I'm going to show it to you so that you can see it. I can tell you anything, but I want to show you exactly what I'm talking about. Every now and again, you'll catch one. I did not catch this one today, and I'm okay with that because it's the day after Christmas, right? So this is one that I'm talking about here. Okay, so let's highlight the trade that I'm speaking of. I did not, again, full disclosure, I did not take this trade. I did not take this trade at all, but this is the one that I'm talking about. All right, and I'm going to do the same thing I did on the other one. You can see where you have trend and momentum. Trend is up. Your long-term and short-term momentum is up. And it's the same thing over here, right? So on your longer time frame. So now we're looking and we're like, oh, what's going on here? And we see, and we're like, oh, there. What do you have there, Watson? I have an ABC pattern, and I have my trend on my 2 longer time frames up, and my catalyst chart, which is this chart here, tell me the trend is up with a nice pullback to the moving averages. I'm like, all right, we might be off to the races. Watch what this trade did. This trade gave you an entry of about 65.50. Again, I was not in this trade. And she went where you could have completely continued to add to the trade. And she went as high as 711. Just like 45 points. Man, that's 45 points. That's $20 a contract. If you understand what I've been teaching before in the past about compounding, you'll notice that if you add to this trade because you know that it's going up. Why? Because your momentum is up on your larger time frames. And in addition to that, your trend is up on your larger time frames. That is the ultimate time to trade. So therefore, when you do such a thing, you are putting yourself in a major position to be able to capitalize on the markets. Point blank, period. So with that said, here's my nugget for today. If you trade the trend and you find reversals, I assure you, more times than not, you will make money. Where people lose it at is when they trade in consolidation and when they don't have alignment and they're trying to force the trade. Allow everything to come to you, and profits are yours abound. On that note, I appreciate you guys logging in. See you on the other side. Have a happy new year. Hopefully I'll see you the rest of the week, though. Talk to you soon. All right. Bye.
Part 2. How to scale the max.
Good afternoon, ladies and gentlemen. We are back for another edition of Trading in the Markets with the Profit Stalker and his crew. Today, we're going to do a class, how to scale in the markets. This is part 2. I put a part 1 out. That's like an introductory to an actual trade that I actually took and did scale. In these particular examples, these I didn't trade. We didn't trade today. We didn't take any trades today. However, there were opportunities to get in and scale, but I want to be able to show you guys how this works. Full disclosure, let me go ahead and give you this. We're using, I don't mind telling anybody, we're using 2 momentum indicators. Let me get this on here first of all. I apologize. Settings on here. So let me get my settings together. All right, there we go. We're using 2 momentum indicators. And we're using the 10-20 moving average, okay? Just commonplace stuff. We're not using indicators to trade. We're using indicators to confirm what we're seeing in price. Today, we're going to explain to you exactly what that means and how you can use this particular method to maximize your profits. So here we go, right? We're going to go to the beginning of the day, and we're going to look at the 8100, the 900, and the 300. Again, this is I say this all the time to everybody. Price trades in volume and price. Markets, trade in volume and price. I don't care what market you're trading, it trades in volume and price. Anything else is not necessarily a true indicator. The indicators I have are momentum indicators that are designed to mimic price as closely as it possibly can with what I'm trying to see. If you want to know what we use to trade, you should look at how to read the stock market or how to read stock charts that's in my playlist. I'm going to be putting this in my playlist as well, how to scale in the markets. That's the introduction. Let's get to it. All right, so 9:30, and let me move before I get started, take my countdown timer off of everything here, because I want you to be able to see the charts. I don't want to have to keep moving back and forth. And I like to do like same day or live charts. I don't really like to do too much historical data because it might not apply to today's time. So that being said, here we go. All right, so first part of the day, we'd be looking for a long right there, right? On this bar that I'm about to highlight, we'd be looking for a long right here. Well, Profit Stalker, why would you be looking for a long right there in that area? Number one, because price tried to come down, failed, and closed at the high, giving us a bullish bar. Okay? Give us a bullish bar there. So at that point, what I now need is I need for my trend to change on my 900 chart, my middle time frame. So now I need the momentum to shift, which it did, to the upside. Once all of that happens, now I'm looking for a pullback. Okay? A market structure pullback. I did not get the market structure pullback here, which would have been nice to get. It didn't give us a market structure there. However, she gave us the market structure here. Also, you hear me say this all the time. If you know how we trade, you know we trade trends and reversals. Well, I know for a fact that this is a reversal at this point, and I'll show it to you. We have a market structure pullback, and we have a ABC pattern right there. At that point, I'm putting on my first contract. At that point, right in this area here. Then, once I see the market go in my favor, right? Once I see the market go in my favor, son, I'm going to put on when it tries to come down and fail, I'm putting on another contract right here. This is typically, you can go back and look at the video, the introduction video, and it'll show you kind of typically how I do this, right? And then comes down and fails here and starts going back up. I'm entering it again here. Just me personally. Okay. Now I'm looking at this point. Now I'm starting to analyze and see what's really going on. Right? For me, I'm starting to analyze and say, okay, am I, is it asking some questions like, is this mature? Is this move mature, or is it just getting started when I've got my third contract on? Is this move moving with some veracity, or is it really just kind of stalling? And you can tell that by looking at stems. This is a nugget. Listen to what I'm saying. You can tell by looking to see if there are a bunch of stems or a bunch of long bodies on the candles. If there are a bunch of stems, there's a lot of indecision. If there are a bunch of bodies, that means that people are really, really believing a thing. So at this point, I have a body and I have a stem. But then price moves and it closes higher. I would try to potentially get in another contract there. Plus, it gave me a nice another ABC pattern. So I probably would have entered another one right here. Let me explain something to you. And let me give you very bad numbers so that you can see. So I got in one contract at 14. My initial stop on that is 5. So my initial risk on this market, which we're trading the NASDAQ E-mini futures, is 9 points. 9 points times $20 is $180. So I'm gonna risk $180 to see how much money I can actually make. So now I got my original entry at 14. My second entry, again, I'm giving myself a bad price at $22.50. Keith, if you don't mind, would you please do the calculations on these, please? So one entry at 14, another entry at $22.50. Okay?
Okay.
Then I get my third entry at 26. And I'm cooking over here, right? I'm feeling good about myself. Then I get my last entry here at 28, thereabouts. Let's just say 30, Keith. Let's just say 30. So, Keith, when you add those prices up, can you tell me what the average price is for those 4 contracts?
$22, 22.16.
22.16. So that means
we're gonna round up.
My average price is 22.16 based on what Keith has said, right? So now I got an average price of 22.16. I'm letting it go. When I get here, I'm getting out of everything. The reason why I'm getting out of everything here, ladies and gentlemen, is because it went down, tested these highs and failed, and then got below these lows. And then once it started going lower, I'm like, I'm going to go ahead and get out. So I'm going to get out of everything at 36. So, Keith, I need you to do some quick math for me, right? So take 36, subtract 22.16, then multiply it times 4, then multiply it times 20.
Times 20.
Yes. Subtract 22.16 from 36.
Yeah.
Then multiply that number times 4. Then multiply that number times 20.
$2,857. That's some change.
You see, ladies and gentlemen? And I risked how much at the beginning? Can anybody tell me?
180.
So I risked $180 to make $2,000. That is how professionals trade. I'm going to go into it, and I'm going to give you another example. I'm going to give you 3 examples today that actually happened because we got our mentee in here, and I'm training him today. So we have that situation going on. So that's that, right? So now we go to the next. The next trade, and I'm not going to do any diversion trades. The only thing I'm going to do is lower high and higher low trades. The next trade is this lower high right here, right? This lower high right here. I'm like, ooh, okay, all right. So then we get into that trade once we get a nice pullback, right? And again, you get in your first contract. I already have it here. Keith, if you don't mind doing this again for me. We have our ABC pattern. We have our pullback, our nice pullback. Now we're going to be entering this trade at about 70, let's just say 70 even, right? Let's just say you got a bad price. 70 even, right? And then we're going to be getting in another contract here. Oh, I'm sorry. We're going to get in at 70, and our stop on this particular trade is 85. So we're going to be risking $300 on this trade, okay? So bad price in, bad price out, you're going to be risking $300 on this trade. So now we're going to enter in another contract. Let's see what we got. That's it right there, right? Gonna be entering another contract there. And it's like, okay, she going down. So we enter another price. We're in first price at 70. Second price, we're going to get is 53. Okay. Mm-hmm. And then it goes down again. Right? It's like, oh, it's going down again. I'm gonna get it again at 45. Okay, so let's just say, so now we got in 70, 53, and 45. Mm-hmm. And then I'm going to be out of all of these trades at 46. So Keith, before we go to I'm out of everything at 46. Can you give me the average of the 70, 53, and 45?
56.
56. Okay. So what I want you to do is subtract. My average price is 56. Yeah. Subtract 46. Right? Yep. Multiply that times 3. Then multiply that times 20. Tell me what number you get. How much? 600. 600. So the first trade we made $2,200 on. Second trade we made $600 on. Okay. So next trade, we have a lower high right here. Have a lower high right here. Oh, okay, cool. We wait for our trend, wait for our chart to go in the trend. And then, we're going to get in this trade right here. And we're going to get in at about, honestly, you're going to get in about 68, okay? And you're going to have an initial stop of 78. Now, there's good and bad news about this trade. Now, I'm going to show you what it is. Got in at 68, stop is at 78. You only got in one time on that trade. Well, no, hold on. I take that back. I didn't see that, guys. Didn't see that. So then it tried to go up and it failed. So I got in at 68. And then I got in my next one. Let me erase this. Erase this drawing. And then let me make this a rectangle so everybody can see it. So you're going to be getting in about here, and about here. So you're going to be getting in at 68, right? Another 3 contracts, right? You're going to get in at 68. You're going to get in another contract at about 49. Then you're going to get in another contract at 42. Okay? Keith, can you give me the average price on that one, please?
28. What the three prices again?
The three prices are 68,
68.
49, and 43.
That's a short. That's a big one. All right.
But then divide that and tell me what the average price is.
All of the charts are starting to align.
Average price is 53.33. Yeah, Ronald, they are. But if you take a look at the 8100, it's still within that range and it's consolidating. So I'm not sure if that's something we want to take because it could slip us out. Can you confirm, Keith?
That's what I was looking at. I was trying to see what the range was gonna look like. It does look like it's in a range a little bit there. I got it about 2150, and it's kind of testing that range. So if it breaks up and gives you the trade, I think that's something we should look at. Depending on what it does, and see if it gives us everything we need to see. Because if it pushes through, it should work. I understand the consolidation, but it's at the top now before we get the trade. So we got some stuff that needs to happen first. So if all that happens, I wouldn't give up on it quite yet. Let's see what it does. I wouldn't rule it out.
If it touches or push past that resistance line, should be looking
But
at
not
it.
that one. Yeah, that's 60. That's another one that's not drawn. I have it about on that previous consolidation that we're in right now. I have it about 23-ish. So let's see what happens here. You got the one bar, you need a market structure here. Ooh, it didn't push up like I wanted it to. But yeah, that and it's flat. So and you didn't quite get that. Ew. It didn't give you the ABC pattern.
Well, we'll keep our eyes on it. It's moving closer and closer. We got about 5,400 contracts to close before we know what that next chart, the next candle's going to do. So I'll go and play the video again.
Right.
53 by 33. Ladies and gentlemen, and then we would have been out of that trade at 46. So 53.33 minus 46. 7.33. Now multiply 7.33 times 3 times 20. What 39? How much? What 39.80? All right. All right. It's 12. We don't really typically trade past 12 o'clock. So let's go to the next trade here. That was this. And then, because we wouldn't have taken that, suffered through that little bit there. But what do we have here? We have another entry. And we have our ABC pattern. And let's just hypothetically, let me see. No. We're going to do this. I'm telling you, I would not have taken this trade, but let's just say we did, but this is the truth, right? Because in the moment, you might have taken this like, it's going to continue to go down. So in the moment, your stop is 72, your entry is about 62. Keith, everybody, that's a loser. You're going to lose $20 on that trade, period. You're going to lose $20 on that trade. But you got to pay attention because it stopped you out and then gave you the ABC pattern that you were looking for to begin with. and you get in at 62 again. When you get in at 62, you'll get in at 62. Keep add these numbers together for me. 62, 52, and 40. So those are the three there.
Mm, 51.33.
51.33. And you're going to be out of that trade at, I'm not adding the more to this one. I might, but I'm not going to say I am. I'm not going to say I am because I probably, just being realistic, I don't know about if I would have been adding in here or not. But I am going to tell you what we're going to get out of it. So we're only going to add, no, I'm telling you now, I would add it. So, do you remember the three numbers, Keith, or you just have it?
Right. It's 51.33 is the average. You want to add another one to it?
I'm gonna add two more to it because I'm telling you now, I would have added another one because everything's down at this point. So I would have been adding again at 31.
31.
Right. Now I would have been adding another one at 20. So we'd been in 5 contracts on that trade. All right. And on that trade, you make what? You would have been getting out at 24, 25. So let's just say you got out of everything at 25. So give me the average price, Keith.
Average price was 41.
And we're getting out of everything at 25.
Yeah, it was 16 points.
Okay, so multiply 16 times 5.
Right.
Times 20.
5 times 22, 1800, 1600. That's not right.
So
hey, that's right. That's right. 16 times 5 is 80. And then times 20, 1600.
So the original risk on that trade was $200. So ladies and gentlemen, this is how this goes, right? Listen to what I'm telling you. If you learn how to scale, you will be risking I'm talking about 1, 2, 3, 4, 5 trades. We only won 75% of the time. We had a losing trade. But on the winning trade, we made $2,200, $600, $439, and $1,600. Keith, can you add those numbers up and then subtract 200?
That's 400.
Plus 439, plus 600, plus 2,200. And while you're doing that, I'm going to go ahead and make sure I show this last trade here. These are all the trades, ladies and gentlemen. This one here. And this one here. And we enter this one again here.
It was 4 trades, right? 1600, 439, 600, 2200.
Right, and it was 5 trades technically. We had a one loser for 200.
Minus 200.
Yeah, so what's that total?
4,639.
Ladies and gentlemen, listen to me and listen to me well. If you learn this process, everything about your life is going to change. You have to learn how to, when you're right, you cannot be right enough. If you're able to be in 100 contracts and you're right, you should be in 100 contracts. But you should let the market prove to you that you're right. Because here's the other thing. I didn't even mention this. If you go back and look at this trade that I talked about, let me see if I can draw it here. I said that we were going to get out right there, right? Here at this mark. But I said we got in our last contract down here at this 20 year. If you get into trading and your trade proves right and you systematically get into that trade, Let me explain to you what will happen. You will start to play with the market's money, and you will start to be in profit so much that you cannot lose. I will repeat that again. If you prove yourself to be right, and you systematically add on to your trade, eventually you will be in so much profit that you cannot lose. That is how professionals in the trading space trade. You risk 200, 180, 300, 200, and 200 to make $4,639. That is how you trade and turn $2,000 into $1 million in a heartbeat. The only caveat to that is you gotta have the discipline to do that. Most people on the face of the planet don't have what I call iron will discipline. But if you want to become a millionaire trader, if you want to become a successful trader, if you want to become a profitable trader, you will have to develop iron will discipline. And you will have to write down every time you make $1 and every time you lose $1 so that you can then understand where you are. Let me give you a secret. This is a literal platinum nugget. Matter of fact, I'm gonna go ahead and tell you. This is a Black Panther kind of vibranium. Is that what they call it? Vibranium nugget. If you want to become a millionaire trader, I need you to listen to the words that are coming out of my mouth. You have got to constantly see that in your mind. And you've got to constantly monitor your progress. And you've got to constantly readjust and keep making until you get to $1 million. You will not make $1 million, $2 million, $100,000, $10 until you consistently see that every day in your mind and you actually do something to try to go there, right? To try to attain the thing. And you systematically scale. You don't do that, you got a better chance of kissing your elbow than getting to $1 million. Now let me see you do it. Ladies and gentlemen, that is it. That is how to scale
All right,
in
Ronald,
trading and investing for today.
you got Ronald.
Hey.
Yeah.
This market moved up out of that consolidation. I was expecting it to be an ABC pattern to go back down, honestly. But you can see, because you see why I drew the ABC pattern here. But the ABC pattern did not work. Now, the thing is, this momentum, it did make a higher low. And we could have taken trades in consolidation, but what I'm not going to do is call consolidation kind of trades. I'm not going to call consolidation trades in a situation like this. Because this thing right here is this is tomfoolery right here, in my opinion. This is yesterday. No, this is Friday. So you have Friday's action. And then you have, Monday was literally nobody was trading with people that were overseas. And then you have, today's action is trying to figure out what it's trying to do overall, per se. But that's fairly strong that she came and bounced off of this resistance, this support, went back up, came down, couldn't get back below it. She's back above this resistance area here. So I want to see if she pulls back. We did have black and white trades. It was just trades in consolidation, right? It was the only thing about it is that trade happened dead smack in the middle. I thought I heard Keith say in this area here, like it's right there in the middle of that consolidation point when he gave it to you. The only thing I did notice was this was an uptrend ABC pattern here, right? This is an uptrend, and this is your correction, right? That's the only thing that I did see that I did like, because you have an uptrend, and now you have an ABC pattern there, right? So I did like that. But we don't trade the 900 as an ABC pattern. We trade the 300 as an ABC pattern. So, because that stop would have been a bit harrowing for you, which you're talking about 950 to 92, talking about, I mean, that's almost 20 points of risk on that particular trade. But it did go 20, it did go from 909 plus 20 is 28. It did go 4 times that amount, just about, though, or close to it. It's getting there anyway. No, it went 4 times, because the entry was 909, and it went all the way to 995.
Oh, wow.
Jeez, Louise. So there you go. We just wait on a pullback. That's all. We're waiting on a pullback. Key, we can play any of the audio books that are from what am I trying to say? You can't play, you got to make sure they're not copyrighted. So
yeah, I got a new one from Heike Ashley Trader.
what's it
it's
called?
How to start a trading business with $500.
Oh, cool. You can play that. Yeah, play that.
All right.
All right.
How to start a trading business with $500 by Heiken Ashi Trader. Performed by Jack Sanders. Chapter 1. How to become a trader with only $500 at your stake. Most new traders, when starting out, have a small account. The sum may be different, but almost all of these traders start with a desire to increase this small capital sum quickly. This need is natural and understandable, but the urge to do so fast is the seed for future failure. Whether they start with $500 or $1,000, most beginners feel that they are only a small fish in the stock market. They want to change this as quickly as possible. They believe that the only way to get to a big account is to multiply their little account fast. Because then, if the account is large enough, they can quit their job and make a living solely from trading. As such, they begin to look for trading strategies that promise them the highest possible returns. That these strategies usually are associated with high risks, they stubbornly ignore and plunge headlong into the adventure of trading. The result is that most of these $500 accounts no longer exist after a maximum of 3 to 6 months. These statistics show that this is the likeliest outcome. If you start trading with the need to increase your account fast, you will give this goal all of your energy and attention. This means that you will not focus your energy on what you are supposed to do first: to become a good trader, hence to acquire good trading habits. Even if you have access to more substantial funds, I would still advise you against transferring these funds to a trading account. You are at the beginning of your trading career and certainly not yet in a position to manage this capital effectively and responsibly. First, it is wise to learn to only trade a small account. If you only have about $500 or even less to trade, I see it as an advantage rather than a drawback. I understand the desire to make money fast all too well, as I had this need too when I started. This need led me to concentrate on multiplying this little capital fast, rather than learn the craft. Admittedly, $500 will not get you far. However, it is important that you learn to appreciate even this small sum and deal with it responsibly. As responsibly as you would if it were actually $500,000. Irresponsible is, of course, the use of disproportionate leverage that most brokers unfortunately make available. With $500, you can actually trade $50,000 with many Forex brokers. But that does not mean that you should do it. In my experience, most beginners over-leverage themselves in the market. For example, I have traded more than $200,000 in capital, with only $2,000 in my account. This naturally means stress and a lot of adrenaline. While some individuals are specifically seeking these thrills, it is an unprofessional trading technique. The result is that these traders hold far too long to loss positions and hope that the market will graciously turn so that they can at least approach breaking even. There's a well-known internet video of a trader who allowed his losing position to grow to negative $30,000. He could not believe that the market had not followed his analysis and merely ran against his position. This recording was the apotheosis of a completely unprofessional approach. You will definitely not become a professional trader in this way. In addition, most beginners have exaggerated ideas of how returns can be achieved in the market. Definitely, you can make 50% per month, even more. However, you will have to take high risks. For example, over-leveraging to achieve this. Eventually, this leveraging is going to work against you. This usually happens via a catastrophic trade, such as in the aforementioned video, which destroyed the entire account of the trader within a few hours. I speak here from personal experience. Please forget the idea of turning $500 into $50,000, or even $5,000 within a short period. There exist many quieter and safer methods to grow your money. These work perfectly with $500 at the beginning. First, lower your return expectations. Instead of 50% a month, I would act on the assumption of 20% annual return. If you can do that, you are good at it. I know that I will probably disappoint some readers when I say making 1 to 2% a month are top performances. Nevertheless, they are actually top results, especially when you achieve this performance every month on a continual basis. Perhaps you are under the impression that you can earn $1,000 a month with a $1,000 account. I am sorry to disappoint here, but such returns are possible only by incurring extreme risks. The chance that you will succeed at this month after month tends towards zero. Get it out of your head. It will not work. And if this book can rid you of this illusion, my work is already half finished. I want to stress that there are alternatives to these exaggerated expectations. These alternatives are much more interesting and easier. You can realize your dream of a large trading account one day, but the path to it is probably different than you would imagine. Honestly, I wish I had someone say this to me at the beginning of my trading career. It would have spared me many years of futile attempts trying to multiply a mini account using futures. Of course, you could collect experience in this way. However, these experiences I can pass on. Who am I? I am a trader with over 15 years experience in the markets, who has witnessed all of the vicissitudes of the trading business. I have traded for a hedge fund in Forex trading, as well as for managed accounts. I know this industry and its tricks very well. I have repeatedly witnessed this little drama of a starting trader driving his entire trading account on the wall, and I have done it myself several times. I know what it looks like and how it feels. The problem is not the money. One can get over the loss of $500. You gained experience. It did not work out, but it is not a drama. There are also people who start with $50,000 accounts, even with a $500,000 account. And these accounts often also no longer exist after 3 or 6 months. Therefore, it is obvious that it is not the amount of capital at stake. It does not matter if you start with $500 or $50,000. Something seems to be going fundamentally wrong in this trading business. No matter how much money you have available, this desire to increase the starting capital quickly seems to lead to exactly the opposite. This applies for at least 95% of the beginners. I must confess, this is one of the saddest statistics I know. Imagine if 95% of bakery apprentices would fail in the bakery because baking little breads is too difficult a profession. That this is definitely not the case proves that people are doing something right in the bakeries. Baking bread is a profession that you can learn, provided you are willing to get up early and follow the instructions of the master baker. I declare herewith that trading and currency trading are no more difficult professions than baking. However, the prerequisite is that the new trader is willing to get up early, though not as early as the baker's apprentice, and follow the instructions of the master baker. Concerning trading, the first thing to take note of is the instructions of the master baker. Unfortunately, this does not happen, and that is probably the main reason the statistics are so disastrous when it comes to success in trading. It is even worse. Not only are the instructions of the master baker not being followed, but also the master baker is simply not there. Most starting traders are just sitting alone in their room in front of the computer screen and romp through the market as they please. This book is therefore about the instructions of the master baker. It is up to you, dear reader, whether you take note or not. At least the master baker has done his duty. Chapter 2: How to Acquire Good Trading Habits. It does not matter if you start your trading career with $500 or $50,000. I want to explain in this book why this is so. Trading is a profession and must be learned like any other profession. You must first learn the basics. As a baker, the best way to learn would be to make all your beginner's errors while you are still baking small rolls. The same can be said about trading. It is best that you make your rookie mistakes with the smallest possible account. I know that a whole group of professional traders will get up and tell you that this does not make sense. I recommend it anyway. Of course, you can try out your strategies on a demo account, an account with play money. However, do not linger too long at this stage. Trading begins only when real money is involved, even if the account is small. I want to show you two paths that are open to you as a trader. Both have pros and cons, like everything else in life. But these are two real paths that will enable you, someday, to make a living by trading. These paths are also open to those traders who have only a small sum, $500 or even less. If you cannot imagine now how you can ever enjoy a large trading account, have faith. You can do it. The first way is by remaining a private trader. This means that you will build your trading business with your own money. How this is possible and what conditions must be met, I will explain in the first part of the book, chapter 2 through 6. In the second part, chapters 7 through 11, I will suggest ways in which you can become a professional trader. A professional is a trader who trades with client funds and hereby earns his living. This is a different path than the first, and requires, to a certain extent, a different preparation. Nevertheless, both ways require one important thing. Your effort in the first period will concentrate on acquiring good trading habits, rather than focusing on multiplying a small account quickly. Without good trading habits, you will never be a profitable trader. Neither a private trader who can live off his trading results, nor a professional who lives from the commission of his customers. This is the groundwork of trading. Good trading habits are like the foundation of your future trading businesses. All your strength and concentration in the beginning should aim first at becoming a good trader. Consequently, the money will follow. You should take this crucial and more professional point of view before you begin this profession. When you have wrong-headed views on this profession, your chances for success are low. Hence, you are in for a long, rocky road, as was the case with me. I myself truly thought that I knew better, and that an apprenticeship in the bakery was superfluous. I want to show the 3 most important good habits for a trader by a little experiment. That way, you know what you are getting into when you plan to take this profession. First, I suggest you do 50 trades carried out with Forex pairs. Or, if you do not have a Forex account, with equity indices. These are the specifications. 1. Pick out any currency pair. 2. Throw a coin. If the coin displays heads, then go long. If it shows you the number, then go short. 3. Immediately insert a trailing stop at 20 pips distance from the entry price. 4. If the position after 5 minutes is still in the loss, close it and move on to the next trade. 5. If the position after 5 minutes is in profit, do nothing. Let the trailing stop do the work. 6. you should only have 3 trades running simultaneously in 3 different pairs. 7. Repeat this process until you have completed all 50 trades. The attentive reader may recognize in this experiment that the 3 most important good habits of traders are hidden. I recommend that you carry out this experiment. You will be amazed at what results you can achieve, provided you adhere strictly to the rules. Therefore, we have already arrived at habit number 1. A good trader adheres to the rules without exception. Although it seems easy, more than 95% of traders do not do this. The experiment may appear meaningless to some traders, since no attention is paid to the analysis of charts. That is, no time is wasted with the entry of trades. In addition, the reason a trade has been executed is completely ignored. Moreover, I even let chance decide through the coin toss whether to go long or short, as if the entry is something completely unimportant. There are, however, clear guidelines with respect to the exit rules. In other words, a trader who carries out this experiment is doing everything possible to minimize the losses. The 5-minute rule plays an especially important role here. Again, this is a good habit of successful traders. If a trade does not work out after a short time or is not running in the right direction, there is no reason to stay in the trade. This may sound rigorous, and it is. Good traders are impatient with their losses and close them quickly without hesitation. This is a golden rule of the trading profession. Namely, the preservation of capital is paramount. However, you will also perhaps protect an even more important capital: your trader's psyche. Sticking to loser trades destroys over time your trader's psyche and leads eventually to something known as analysis paralysis. One begins to look unnecessarily for ideal entries, although everyone knows that these do not exist. Either you are at the right time at the right place in trading, or not. If not, then get out of the dust as soon as you can. However, the trailing stop in this experiment does something different. It makes sure that you stay as long as possible in a position when the trade is running in the win. Again, this is a good trading habit. Stay with your winners. If you can do that, you can differ even from 95% of traders. Ideally, your trade should run until Friday afternoon. However, it is not likely, because the trailing stop will be reached eventually. Nevertheless, this is an important exercise. Do not take too early gains, as if you are in profit, but try to extract the maximum from the trade. This follows the 2 most important statements of the golden rule of trading. Cut your losses and let your profits run. 95% of traders do exactly the opposite. I can well imagine that it will be difficult to close a trade that is only slightly in loss after 5 minutes. Do it anyway. I also know what the objection is. But the trade might go into positive territory in the next minute, and then I might miss profit. Yes, that can happen, and it will happen repeatedly. It is part of the trader's existence. The much higher probability, however, is that this trade is just not a winner, but continues in the loss. That is why I recommend closing this position anyway, and moving on to the next trade. When you learn that, you have acquired an important habit. No matter what happens, you do not tolerate losses anymore.
Yeah. That's what's going on.
I do not want to be misunderstood.
What you got,
Yeah.
Keith?
It done made a move, it looked like, but you got momentum's up on the 8100. Oh, it's dropping down a lot, but that's your market structure on the 900. And ABC pattern, if it breaks this high and come back down, see what it do. It
The
might
only thing
already be
about
one.
that is, I hear you. The only thing about that is, if you didn't take this up here,
It's a long move. That will be my next comment. This trade is long in the tooth. But that's it. So, but I just wanted to acknowledge the setup.
yeah, we should have been in. Yeah, I get you. All right.
Of course, you can try through accurate chart analysis to select your entries as accurately as possible. However, I would like to take this opportunity to express a clear warning from my experience. The importance of analysis is greatly overestimated. In my view, traders spend too much time with the analysis of charts. This is no different than trying to predict the future. On the other hand, they spend too little time with a strict observance of their risk management, which is usually the root cause of their failure. I will hereby also not promote the trailing stop. This instrument certainly has advantages, but it also has disadvantages, of which I am aware. With trailing stops, trades are often stopped out too soon by random counter movements. Although the trend might be intact, and there is no reason to get out of the trade. The experiment is to let the trailing stop decide when the gains have been realized. In some cases, this will certainly be too early. However, this tool will also allow you, in some other cases, to hold the position for a long time. This is also a good habit. Thanks to this experiment, you will learn the most important good habits of a professional trader. You will learn to follow your rules, to close losses quickly, and to stay as long as possible with your winners. Believe me, you do not need much more. If you acquire these habits, you will belong one day to the 5% that succeed in the markets. This experiment can be repeated at will, because as we all know, habits are one of the hardest things to change. Try to stop smoking, if you are a smoker. There are traders who have been lugging around bad habits for years, and then wonder why success does not occur. Among them are also so-called professionals. Do not think that all professionals maintain these good habits. Only the successful ones do. With this foundation, I now would like to show you 2 ways that you can become a disciplined trader, even if you currently have a low capital base. Chapter 3: How to become a disciplined trader. Once it has become clear that the principles are the same for all traders, whether they have $500 or more than $500,000, I would like to suggest ways in which you can make a living from trading without gambling with one's life. As already mentioned, most beginners have a completely wrong-headed idea of what returns can be made on the stock exchange. Experienced and disciplined traders generate 20 to 30% profits per year. In good years, this may be 40 or 50% sometimes. This means that these traders are creating monthly returns of 2 to 3%. These returns are achieved with a reasonable risk management. Drawdowns generally remain below 15%. If you trade one day an account of several $100,000, you will, I hope, have appropriated such a risk profile. Now we come to your $500 account. I hope that you have realized that you cannot earn your living from this sum. However, what you may well be able to do is, just like the professionals, make a nice annual return of 20 or 30% earn with drawdowns that remain below 15%. This way, you prove to yourself that you can trade. That is the best thing that can happen to you. For an account of $500, only the Forex market is a realistic option. Therefore, look for a Forex broker who will charge no fees for transactions. Many professionals have been led to conclude that it is simply mathematically not possible to trade an account of $500 because the fees alone eat up the account, not even to mention a reasonable risk management approach. As an example, I want to mention a trade in euros/US dollars with a mini lot of $10,000. This has been, until recently, the smallest possible unit that you could trade with most brokers. If you set your stop 50 pips away from the entry price, you risk 50 pips or $50. At $500, this is 10% of your trading capital. If you lose in this way 5 times in a row, which is not uncommon, you have already lost half of your capital. If you risk 10% of your capital per trade, you are not a trader. You are a kamikaze pilot. The criticism of these mini accounts consists essentially of 2 arguments. First, you can only trade one strategy at a time. Therefore, you are completely dependent on the results of this one strategy. You cannot diversify. Second, you cannot have a reasonable risk management having just this small sum to your name, as this example in euros/US dollars clearly shows. It is fortunate that some brokers had this insight, and they are offering currently their customers micro lots. These are only 1/10 of a mini lot. Therefore, you are trading with only $1,000. In the same example, you would then risk only $5 or 1% of your capital. This sum is much closer to a reasonable risk management for private traders, although I personally still find 1% risk per trade too much. It may not sound exciting to trade with $500 in a disciplined way for perhaps 12 months, and consequently get a profit of 20%, or $100 more in your account. However, this is exactly what you should do. You should learn to trade this tiny account as if it were $1 million account. For this purpose, I recommend to keep a detailed trading journal that logs all trades exactly. In addition, it is useful to make weekly or monthly statistical evaluations. How to do this exactly, I have outlined at length in my book, How Do I Rate My Trading Results? You can find the book on Amazon. The task, therefore, is to carry out a disciplined strategy in the market you have selected for at least 1 year. Mind that I said one strategy, and not 7. Many beginners start with one strategy. If then the first losses show up, they are disappointed, discard the strategy, and look for something new. Then the cycle starts again from the beginning. This behavior definitely does not belong to a good trader's habits. Therefore, you should stay consistent with your chosen strategy, no matter what happens. The reason is simple. If you have ever traded with one strategy for a year, you will never learn this strategy in a profound way. Each strategy has loss phases. It does not matter which one you choose, as long as it is profitable. This alone will discipline you enormously. If you replace your strategy repeatedly, you will never learn to know yourself as a trader. That is the point. So stay with your choice once made. In addition, you should keep a detailed trading diary. By that, I mean a full coverage of your trades. Such a journal should contain at least the following data. Date of entry, for example, the date when you have opened the position. Name of the Forex pair. Entry price, the price you have bought, long, or sold, short. Stop loss, the risk you have run into in this trade. Take profit, the target that you wanted to achieve with your trade. Position size, how many micro lots you have bought. Date of exit, for example, the date when you have closed the position. P/L, profit/loss, in pips. How many pips have you earned? You can still add other data, but these are definitely the most important. Why should you do that? If you consistently collect this data from all of your trades, you get a wealth of information about your trading, which is worth more than all the trading books together. You may find out that you are better in short selling than going long. If so, would it not be reasonable to specialize exclusively in short selling? Do you know that some traders are owned 100% short sellers who never go long? They do this because they have recognized based on their data that to go short is the best thing for them. I, for example, am a good short seller and a bad long trader. You might notice that most of your losses are in a particular Forex pair. I myself am bad in the Great Britain pound/US dollar. That is why I avoid this pair most of the time. For that, I am good in Swiss francs and good in the US dollar/Canadian dollar. I know that just thanks to my trading journal. Isn't that valuable information? At the end of the week or month, you should evaluate your trading data. This too I have shown in detail in my book, Scalping is Fun, Part 3. How do I rate my trading results? Here are the key figures for your statistics. Number of trades per week/month/quarter. Number of winners. Number of losses. Number of break-even trades. Average win. Average loss. Hit rate. Your number of winners in percent. Payoff ratio. Profitable or not, and how profitable. Expectancy. Expectation of your system. The statistical information that can be found in your trading journal is perhaps even more valuable than the trading data itself. They show how robust your system is. Moreover, Such an evaluation also shows at which screws you need to turn eventually to make your system more profitable. Maybe your losses are a little too high, and you should set the stop loss closer or farther away. Maybe you always want to win, the hit rate, and you do not pay attention to the height of the profits. The traders whose career I describe in detail in my book on money management had this problem. Consistently maintaining a trading journal also belongs to the good trading habits. Make it so from the beginning of your career, even if you only have a $500 account. Chapter 4: The Fairy Tale of Compound Interest. Before we take the next step, we have to deal with something that haunts in many internet forums, namely, the story of compound interest, also called the greatest force on earth. It is almost too good to be true, and many traders actually believe that it is possible to let their tiny account grow to a large account within a short time thanks to the compound interest effect. The compound interest effect goes something like this. Let us say, for simplicity, that you have $1,000 in trading capital. Your not immodest goal is to earn 10 pips per day in the currency market on average. The statement goes like this. On day 1, you make 10 pips and therefore have $1,010 in the account. On the second day, you make 10 pips again. Now you have $1,020. After 20 days, you are already proud of having $1,220 in the account. This is, after all, 22% in your first month. You eventually need 70 days to double your account. You will then have $2,000 in the account, provided you have gained 10 pips a day on average, and you raise nothing from your account. Since the capital is growing every month, you can of course risk somewhat more every month. You increase your position size with the increasing balance. In the first month, you are still trading with a mini lot, $10,000. Since after 1 month, you have $1,200 in the account. You increase your position to $12,000. After 2 months, you are trading with $17,000, and so on. Perhaps you are still not impressed by these figures. The idea is that if you do this in the next few months consistently, you will eventually experience the power of compound interest. If you are trading in this disciplined manner, your trading account will stand after 12 months at $24,000. If you do it again in the second year, you can call $500,000 your own. You must then only trade 3 months until you are a dollar millionaire. Mind you, with 10 pips per day. Convenient, is it not? You can do the math in a quiet hour, but it is true. You can be a 4x millionaire with only 10 pips per day within 3 years. I know that many beginners are impressed by this compound interest story when they hear of this idea for the first time. You do not need to be a mathematical genius to understand this simple calculation. It is the secret hope of many trading beginners that they will be able to achieve this masterpiece, thanks to their trading skills. If you succeed, give me a call. You would probably be the first in the world. Why does almost nobody put this into practice? Theoretically, the calculation is correct. I certainly do not mean that the compound interest effect is not working. It works safely, and in principle, every trader is trading with some sort of compound interest effect. You probably guessed what the issue is. In this calculation, there are some unknowns, which have not been taken into account. These unknowns have, of course, what it takes. It has a lot to do with good or bad trading habits, of which we have already spoken. If you initially worked hard on your good trading habits, the opportunity certainly exists that you will experience some form of compound interest effect. However, say goodbye to the illusion that you could trade and make an average of 10 pips per day, or if you want 50 pips per week, as desirable as this might be. The reality looks more like this. In some weeks, you will make perhaps 36 or 128 pips. However, it could be that the week after, you have a 92 pips loss. In addition, the next week, you do not trade, because you must stay in bed with influenza. You will experience good days or weeks where you will achieve good results, and you will experience poor, even bad weeks. The progress? A trader who is working on their weaknesses and on their strengths, will surely make progress. Nevertheless, these do not come immediately. Sometimes you have the feeling that nothing happens for a long time, and then suddenly, there is a breakthrough and you are trading much better than before. Many traders need to experience the destruction of their first, and often their second $500 account. You need not be ashamed of it. Several times, I myself have brought smaller accounts to $0. This was, of course, because of a lack of discipline. After such a debacle, it is often good to take a break and think about your trading strategy. You would not believe how much better you can trade after such a break. With increasing confidence, you might succeed in significantly increasing a small account. You should experience at least a doubling before ever transferring additional money to the trading account. Remember what we said in the first part on good trading habits. Chapter 5: How to trade a $500 account. You will start to trade this little account with extreme caution. Of course, it depends on your strategy. If you risk 50, 20, or 10 pips per trade. The exercise consists mainly of preserving the capital. If you do, then you have already taken the first important step to success. Of course, your account will grow much more slowly in this way. However, do not forget, your goal should not be to increase your $500 as soon as possible. For the time being, you should use this sum to learn to trade. This means, in the first place, to achieve a regular return with a manageable risk. Returns of 2 to 3% a month there are already outstanding, especially when the risk, drawdown, remains below 10%. Find out more in the chapter on professional trading. The idea to grow a mini account of $500 by virtue of compound interest to $1 million or even $100,000 is a totally crazy idea. It is unlikely that you will succeed, and this goal will overwhelm you immeasurably. You will again take too big of risks in order to achieve this. Do you see the pattern? First, it is about learning your craft. If possible, try not to think on the money. As I said, 2 to 3% per month is already good. Consider this. 2% on a $500 account is $10. Let us be honest. Working, disciplined for a whole month for $10? This will not bring you forward financially. I hope you understand the absurdity of this idea. Just say goodbye to this idea to earn money from this little capital. Is it not then completely pointless to trade a $500 account? No, it is not. Learn your craft with this small sum. If you are able to proliferate this account in the course of some time without taking greater risks, you have yourself proved that you can trade. Trading is a craft and a profession that needs time to be learned. Half a year is a short time. As a rule, the learning curve of most traders I know will take much longer. One consideration is thus the above described. Simply not to try to make money with a $500 account. This trial period then only serves to learn the craft. There is a second approach that makes sense as well. Some traders with a small account have the goal to earn an average of $10 a day. This is a manageable goal, is it not? You may say, $10 a day? Are you joking? That's pure child's play. Maybe. However, can you make this $10 without risking more than $10? And every day? It is a money target, not necessarily 10 pips. So do not start and say, I need to earn $200 a day so that I can get $4,000 from my trading account in the month. It mostly turns out that $4,000 is usually the exact sum that people need per month in order to pay their bills. In other words, they need this money. Therefore, they have to be successful in order to achieve this goal. Can you see this? They do something not out of joy or because they want to learn something. They do it because they have to. Moreover, if it does not succeed, it brings them serious troubles. By this, they put themselves under unnecessary pressure. The consequences are often overtrading, taking too many risks, or trading with too high a leverage. I think you suspect what will happen next. Someone who is under pressure will fail eventually. That is exactly what happens when you hear of a spectator loss in the stock market. I myself have fallen several times into this trap, and I can tell you, those were not my most glorious days. The traders, on the other hand, who want to trade for only $10 on average per day, have probably set themselves a realizable goal. They also are not under the pressure to earn their living from it. $10 per day in a stock index or in a forex pair is feasible. This trader would achieve his or her goal regularly. Thus, they condition themselves for success. Success is then something that feels light, and no extraordinary efforts are required. $10 per day as a daily goal is at 20 trading days, $200 per month. That might not sound like a significant sum of money, but do you know how much money you, with the low interest rates of today, must have in your bank account today to be paid interest returns of $200? Let us take a simple money market account with a maturity of 3 months. You would need about $1 million. Therefore, if you could earn $10 on the stock market on a daily basis, this would be as if you had $1 million in your account. You can see that this goal is not modest. Believe that a trader who can boast this success will find, after a while, ways and means to trade larger sums with the same ease. He or she will do it. Granted, with an additional $200 a month, you will not change your financial situation significantly. However, it is vital to make profits at all. You would not believe how great you feel as a trader if you have completed a positive month. You have the feeling that you have achieved something, which is the case. This is important to emphasize because for people who are not active on the stock exchange, $200 is of course a ridiculous sum. They would not get up in the morning for that. For you, it is the proof that you have completed your apprenticeship in the bakery of trading successfully. You have acquired good trading habits, and that is precisely what matters. There is another reason why I am not a big fan of a strict compounding effect. Reward yourself from time to time. Cunning traders do this. If you have, for example, traded disciplined and made a nice profit for the week, get a part of that gain from your account and make something great with it. Perhaps an evening in the movies with your beloved. The important thing is that it feels like a reward. It signals to your subconscious, well done, continue in this way. It is worth it. Nobody leaves all the money available in the brokerage account from $500 up to $1 million. It is not necessary and just a completely crazy idea. The compound interest effect occurs at some point, but often different than you would expect it. Every trader is different and is differently capitalized from there and has different resources. Not only money, but also time. Sometimes you will have the feeling that it can go fast, but you might also experience periods when your strategy is not working so well. Many traders simply want to take a few months break after a losing streak. Some come only back after a year with fresh ideas. They have perhaps attended some seminars or simply read a good book that will give them a completely new perspective on the stock exchange. Thus, they start with renewed vigor. So you see, the learning curve is not as smooth as one might think. There are fractures, breaks, interruptions. The success itself also is not linear. There are times where you get the feeling you will never learn it, and then there is suddenly a breakthrough. A small change in your trading habits or a tip from an experienced professional may cause this. It comes in waves, and waves run back occasionally. If you then are able to generate regular returns, only then you should think about to trade with larger sums. From here, there are two possibilities. You can decide to become a professional trader and to trade with client money. How to do this? I will tell you in Chapter 8. Alternatively, you may decide to stay a privateer, trading perhaps only part-time and still working at your day job. Whatever you decide, try to operate your trading as a business. If your business still yields little money and you are trading with a very small sum, try to trade as if you had a capital of $1 million. This profession depends strongly on the inner attitude. The more seriously you do this, the sooner a door will open to you that offers you the chance to realize your dreams. If you have taken seriously the path to become a good trader first, you will experience that things will happen that you do not hold possible now. There might be people coming to you, offering you money to trade for. Whether you should accept this money is another matter. You should decide only after careful consideration. It has much to do with the seriousness of which I spoke earlier. As long as you are not a disciplined trader who knows the craft, under no circumstances should you manage money for other people. I hope this speaks for itself. It even can happen to you that a hedge fund calls you. That happened to me once. This fund was in trouble and urgently looking for a trader who was able to generate at least a little positive return for their customers. Nothing else was working. I started to trade and soon made gains for the fund. Nevertheless, the management had apparently not learned its lesson. All the problems had arisen because the automatic trading systems, which the fund had initially used, only burned money. Therefore, I came in the morning and began to trade the account successfully. But the management was apparently so convinced of their automated trading systems that they ran these again at night. The result was that the gains that I had earned during the day were destroyed at night by the robots. Can you imagine a more absurd situation? Believe me, even with the so-called professionals, it sometimes goes haywire. Talents are always in demand. Now do you understand why you should first learn to trade in a disciplined way? These people also know that you do not have $5 million available to trade. If this were the case, you would probably not be interested in the job. It may of course happen that you suddenly come into money, or even still had some money saved up that you had not previously used for your trading. When you are ready and have the feeling that you can deal in a responsible way with this amount, you can dare. Do me a favor, however. Do not put the whole sum in your trading account. You'll probably do it anyway, but I've said it at least. This is the most common case. Most traders I know are trading with their own money, and that's a good thing. Managing money from other people increases the stress considerably. Can you cope with this and achieve good performance anyway? Maybe you inherit a sum of money one day. This too is of course possible. Should you accept money from relatives? Frankly, I would advise you not to. If someone gives you money and says, "I do not care if you burn it or grow it," then you might think about whether you accept this money. In my experience, most relatives do not.
I think you might have had a short there, but I didn't see if he gave you the ABC pattern or not. And it broke that market structure by one tick. But I don't see the ABC pattern. I see the arrow, but I don't see the ABC pattern there. So
Come on, right here, Keith.
Yeah.
It's not an ABC pattern. It's just a healthy pullback right there. I'll be real with you. I wouldn't have thought to call that trade there, simply because it's what's happening in today is the day is a move and consolidate day. Let me show you what I'm talking about. You made this move down, then it consolidated, right? Let me show you what happened before this move up. Before this move up, consolidated here at the bottom. It really wasn't going anywhere. Made a move up, consolidated, made a big move up. It's not really moving. I mean, it gave you a market structure pullback right here, which is what you would have really wanted to have taken. I didn't call any of this because of the consolidation area on the 8100, of course. And this is why you don't. I told you, you see how it's at this resistance area, and how every bar for the like 1, 2, 3, 4, 5, 6 bars. So from 11 o'clock for the last 15 minutes, every bar has hit that area. So that says to me that thing might be trying to go up. And then what we'll do is wait on that pullback. I would be interested in the trade potentially, but it just depends.
It didn't give you the ABC pattern, and now it's momentum going up. So I don't think it triggered for us unless you
No, no,
just
no,
take
no.
it
It triggered which way?
short.
Oh well, if you, I don't, cause what I can't do is I can't tell if that red bar broke the high, that green bar.
It by a tick.
I
On mine,
mean,
by a tick. But like I said, I didn't see the ABC pattern necessarily, which is why.
I mean, yeah, it's tough because if it was an ABC pattern, it's ABC pattern by a tick, and there you go. So, this is going to be a telltale sign right here, though, in a good way, because this is, I don't talk about this often, but I'll talk about it now. This is when you'll have the 2B. You got a confirmed 2B with a retest. If it breaks the high and then pulls back, that might be a little like a really, really nice trade. Actually, it's a really, really nice trade now. But we'll need to wait on it to go red, and then need to go red first. We need it to go red. And when I say red, I mean we need the momentum on the 900, the short-term momentum on the 900 to go red. So it's just consolidating here. Just consolidate. So
All right, then.
that 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 book is very good. I got a lot of his stuff. I hadn't heard that one.
I sent you guys a text message about you getting it for less than what I paid for it. Um, so if Ronald can put his email in the chat, I'll go ahead and send the email out.
All right, cool. Hold on. That is ridiculous.
All
That's ridiculous. That thing popped, boy.
Wow.
It popped.
Yeah.
But it's popping. And this is what I'm saying. Today's a day where you'd have to trade out of consolidation, assuming that it was going to go up. That's just really not what, I mean, you had this trade that happened here. This is the only one that I would have told y'all to take, to be honest with you. So then you had this one here. Both of them came out of consolidation and then popped up. So we wait. We wait. It's tough as far as, it's not tough. Let me cancel. That's not it's not tough. It's just a matter of trading what you want to see. And not trading out of consolidation. So yeah, we just wait and chill. It'll be there. It'll be here.
Yeah, it can.
Say that one more time.
I said I'm gonna go ahead and play the book back again. I am at 11 o'clock. Or just before 11, I've got a virtual doctor's appointment, but it shouldn't take that long.
Okay, no, that's fine. I understand 100%. Go ahead.
That sentence. Most look rather with a critical eye at your new activity as a trader, or give you the money with expectations. I would be careful, because no one knows if you will be able to meet these expectations. Chapter 6. Social Trading. A good alternative for undercapitalized traders is social trading. I have experienced this myself and can only recommend it to a very ambitious trader. Some of these sites are now working very professionally and much more transparent than any investment fund or asset management. Here, in recent years, a small revolution has arisen in the area of money management, and I hope that this democratization of asset management may continue to develop so that many people on this planet can benefit from it. It is precisely here that the good habits and disciplined trading are in high demand. All your trades and their statistical evaluation are totally transparent and open cost for the entire world. Can you imagine this? You trade and the whole world is watching. Nevertheless, this is happening with social trading. Social trading platforms are not more than websites that bring together traders and potential investors. Investors have the money, and the traders have, hopefully, the ability to multiply that money. There are, of course, rankings, and the investor can choose his traders. He selects perhaps because of their trading style. Better, he chooses due to the disciplined trading behavior, how the trader earns the yield, and the low level of risk. At least the smart investors do this. In addition, professional asset managers look now at social trading and consider whether they will invest a portion of their customer deposits there. Is that not incredible? It is definitely a fantastic opportunity for an ambitious trader. Now, do you understand why you should first learn to trade responsibly and disciplined with your $500 account? If you can do this, you can start with a clear conscience at one of the social trading platforms. It will provide you with an account with fictitious money, which you can trade. If your results are good and you have built a good track record, after a few months, you may soon get your first customers and therefore earn money. The earning models differ, so have a clear look at it, because this will ultimately determine how much money you can earn with your trading. Now, we want to look at the compensation model of a social trading platform more in detail. It usually works with one or more brokers. These brokers are most likely called introducing broker. That is, this broker connects between its clients and a so-called prime broker. A prime broker is the place where the settlement of securities transactions actually take place. These are generally well-known institutions such as J.P. Morgan, Credit Suisse, Deutsche Bank, etc. Most introducing brokers in the retail business therefore have a connection to a prime broker. Those are not interested in small accounts. The introducing broker performs this task. These houses are familiar to most retail investors. Now, we look at the entire food chain of a social trading platform. 1. Prime broker. 2. Introducing broker. 3. Investment management. 4. Social trading platform. 5. The trader. You see, many people eat from this cake if the trader performs a transaction. That is also the reason why the spreads in social trading generally are higher than if you simply open an account with an introducing broker. Expect 2 to 3 pips spread on the euros/US dollars. Thus, twice or even 3 times more than usual. That is also the reason why pure scalping in social trading is not working. The conditions just aren't there to do this. Too many people earn on the spread. However, if you have developed a day trading or a swing trading strategy that generates good return, you will also earn money with this model. Depending on the model, you will mostly be paid per generated standard lot. As a beginner, you might initially get $1 once you generate one standard lot, $100,000 transaction volume. This may not sound like much, but if you do this 20 times a day, this can become a decent income. If by good trading you manage to climb on the higher levels, you can earn up to $5 per lot. When you arrive here, in general, you will make a good living off your trading. This will, of course, only be successful if you can actually offer an added value, a good return, to your customers. And if you do not make senseless trades to generate as much as possible on commissions. Therefore, have a talk with the management of the social trading platform. They will be able to help, due to their experience, How you can balance out best the numbers of trades with the best earning potential for you. Commissions are therefore an excellent way to earn your living as a trader. If there is still a profit at the end of the profit participation, all the better. However, you must first be able to pay your bills and to meet your expenses. This is especially true when things are not going as well with your trading, or if you get involved in a drawdown, a period in which you lose more than you gain. If you trade only your own money, you will earn just nothing in this period, which may well lead to stress. However, if you are connected to a social trading platform, you will still earn more on the transactions that you perform. If you have previously satisfied customers, they will not run straight away if things do not work out as well for a while. If the drawdown is kept within limits, of course. Therefore, if you become a social trader, first, you can focus on your job as a trader and do not need to take care of the customers. That will change if you should one day decide to trade for a professional asset management. Some social traders earn 5-digit monthly sums. For them, the dream of a successful trading career has already been fulfilled. Prerequisite is, as always, a positive return with manageable, predictable risks. Each platform here offers the necessary tools to calculate your risk management. You can therefore determine your risk profile before you begin to build up a track record. I strongly recommend thinking about it for a while. Traders who generate 20 to 30% on an annual basis with a maximum drawdown of 10 to 15% may have a better chance than traders who achieve the 70% return, but take risks of 45%. The reason is simple. Usually small investors are attracted by the high returns. The retail investor thinks high return equals rapid capital appreciation. If you put on the mass of the little ones, I can assure you that your customers are faster gone than you can think if you experience a loss series. In contrast, the professional always looks only at the risk. His concern is, how much loss can be expected at a maximum when I entrust my client funds to this trader? Logical or not? The consequence is that the trader with a restrictive risk management will receive the larger accounts. Larger accounts mean more capital to trade. More capital means a greater share of the commissions for you as a trader. Chapter 7. Talk to your broker. If you, for any reason, do not like social trading, of course there are plenty of other ways to get to client funds. One of the most direct ways is to talk to your broker. This person or group of people has contacts with many people with money. It is the job of a broker to find these people. If you want to manage customers' money with your trading system or strategy, you might consider having a conversation with your broker. Even if your broker should be dedicated only to retail customers, private customers, it can be worthwhile to talk to him. You never know whom he knows. If you are an active customer with him, he will always have an open ear for what you have to say. It is best to make an appointment with him. Better yet, invite him to dinner. You will be amazed what people entrust to you if you do them a favor. There is another reason why you should talk with your broker before you start trading. If you plan one day to trade client funds, you must also be able to demonstrate that you can do that. That means that you need to present a track record that is authenticated in some way. This is also called building credibility. Without credibility, it might become difficult ever to be admitted to an interview. A certification can, of course, be done in different ways. You can go to a notary, or you can even let perform an audit by one of the well-known accounting firms, like KPMG or Deloitte. However, I doubt if you will get this done with your $500 account, not to mention the horrendous fees for such an audit. It is much easier to ask your broker, who is tracking your trades anyway, to authenticate your results in some way. This certification is not hard proof, as from a notary or an auditor, but at least you have something in your hand that was reviewed by a third party. Now you can safely approach an asset management with this document, although further tests might be coming at you. Another possibility to reach an authentication, if you track your trades via the platform myfxbook.com. This platform is now very well known, and many traders have built up a remarkable record of accomplishment here. Do not underestimate an excellent record in a social trading platform. This may well be considered proof that you can trade. Social trading is a great way for traders to distinguish themselves. Many brokers have an in-house asset management themselves. It is part of their business, even if only a small part. You will find this mostly under the term managed accounts. Moreover, you will be amazed how mediocre these professional asset managers often are. So, do not let yourself be intimidated by the words professional or asset management. Behind those words, you will too often find a trader who has the same troubles and problems as you. Often, some broker even let their managed accounts simply run on, even though they know they're not very good. Why, you might ask? As long as at least one customer participates in this program, this asset manager will incur fees or commissions. Because of this, the broker always makes money no matter how successful he runs his asset management. Who knows? Maybe you are the one who will breathe new life into this branch of your broker. If you offer him an interesting strategy, which differs from the known, your broker will certainly look at it. It is also not difficult. After all, you are his customer. He has a complete insight into your trading history. He knows exactly whether what you do has hand and foot or not. Expect that also here the remuneration models can be very different. Just as, in social trading, the broker will probably offer you a share of the commissions or the spread. What percentage you will receive as a trader depends on your negotiating skills. Everything is possible here up to 50%. However, please remember that you are the one who is doing the work and creating added value. Do not sell yourself too cheaply. If your broker does not offer managed accounts, you should not stop looking for one. A simple Google search will do that. Enter the term managed accounts, and you can choose several asset managers from the list. Some of them will be other brokers that you may not know about. Others might be pure asset managers without brokerage. These houses and their websites can look very secretive and discreet. That should
Hey,
not
everybody.
be up and asking about.
So Ronald asked to go over his trades. So we're going to do just that, go over his trades, see what he did. He's trading sim today. So I wanted to see what he looked like trading. Are you still there, Ronald?
Yes, sir, I'm here.
All right. Give me 1 second. Do me a favor. Text me the times of your trades, and then I'll go over them and we'll look at them.
Okay.
Can you do that? Text me the time of your trades, everybody. Just give me a couple of minutes here. We'll
All right.
I'll wait on Ronald. What I'm waiting on everybody is for Ronald to text me his trades. Hmm. Just waiting, ladies and gentlemen. Let me see here. All right. Sounds like we got something here. All right, let's go over the first trade short he got at 939.
Are you showing it on your screen?
Yeah, y'all, can you see my screen?
Oh, yeah.
Okay, so I'm going to show this trade that Ronald took at 939. He took a short at 939. Let's see. Oh, that's perfect. That's perfect, Ronald. That's perfect. Momentum down, trend down. You got the
Yeah.
market structure, arrow down. Good trade. Okay, I see that. Let's go to the next one.
Quick, I'm hearing arrow down, so he's entering on the arrow, not the ABC path.
Right, because for him, he's just starting out.
Okay, that's fine. I just want to make sure I'm on the same page, so I know what I'm
Yeah,
looking at.
yeah. So yeah, he's entering on the arrow down.
Okay,
So only thing he did was momentum, trend, timing. That's all he
that's
did.
fine.
All right, give me the next one, Ronald. Second short at 945.
940. Yeah.
Uh, let's see what we
Now I
got
think
here.
on the 900.
Mm.
That 945 was a good trade too. Momentum, trend, and
Mm-hmm.
timing
Right there.
is down.
It's
Hold on a
flat,
second,
right?
Keith. Yeah, that's a great trade, man. That's great. 946. Momentum, trend, and timing. All right, cool. So that's a great
All right.
one.
This next one is one of my two that I dropped the ball on. This one was at around 954, and I think I went. Yeah, I had to went short. But I dropped the ball a little bit on that one. I went two contracts, but I only lost a little bit because I realized it was
You went
it
short.
was
And see,
yeah.
that's one of them things I talk about. The biggest mistake you made was you should not, up under any circumstances, on your third entry, enter two contracts if you were only entering
Mm-hmm.
one on the previous ones. But and then two, you don't have 100% alignment because what you have is just the castics, the movement. I mean the momentum here is down. I mean is moving up. So you wouldn't have wanted
Yeah.
to take a trade there. That's fine. Okay, so cool. Go on to
Question.
the
Question. Since that was on 900, right?
Yeah.
What was your entry? How did you do it? Red bar break, through bar reversal.
wait, hold on.
That
Keith, let's get through all the trades first. Just mark down your questions. Let's get through all the trades first because what I'm trying to do is get this in before Quentin has to leave.
Okay, I'm sorry.
No problem. Uh, so go to the next one.
let me see. Let me make sure the time is right. Think is up with my trade log. That's about right. I go. Okay, yeah. So this was around 10. If you go at 10:09 on the 900, it was long, and it went, but you would have had to stay in it for a while. It worked though.
Oh, you went.
I contract one contract on that. You
So
see that when you see green bar pullback?
right, but at 10:09, you don't have a market structure, so you're entering in a momentum on your 900.
At 10, I'm sorry, at 1010. You see where the green bar pulled back at 1010? Move over to the right some more. One more. Yeah, that one.
Right. This is what you want to do is you want to wait for, if you want to, because you're looking at the larger time frame. So you had momentum, had the trend up, right? You had the trend up, but your entry here would have been here in a small stop out. Did you make money on that trade?
Yeah, I won on the trade, but it wasn't a lot.
Right. I see, because right here is mumbo jumbo is what I call it.
Yeah.
And then but the ABC, it wasn't even an ABC pattern. It gave you a market structure pullback. It just was a weird one where it made a higher high and it came back and made a lower low. So this was your actual entry over here at 1012, or you here at 1011. One of the, well, no, 1012, because you had to wait for the market structure pullback. So your trade would have been happening at 1012. And that's fine. You made a mistake on that one. That's okay.
Yeah.
That right there is not, you just entered it, you entered in on a momentum versus a trend on your 900, meaning that the trend was up, but momentum was up and it hadn't pulled back yet. It had gone into a trend. It had gone into a trend, but it had gone to a trend from a low momentum. Now the thing is, I see something that I won't get into, but you just late to that particular party.
Yeah.
You just late to that party, but that's cool. So go ahead. What's the next one you got?
All right, so what's that? That's 3 winners and 1 loser so far. And then now this next one was the one I dropped the ball on. This was at, let me see. This say 10:38, but let me go to that time and see what that was. I can't 100% remember, but I know I dropped the ball on that one. This one, I don't. What did I do? Did I try to? Oh, okay, yeah. I tried to go short. So you see where, if let me see.
At 10:38,
I tried to go. Yep, and it already made a move down, and then there was a red bar that pulled back a little bit, and I went short on the you see where that, let's see, if you go back to the left 2 bars, so that red bar that's to the left of your crosshairs, once it printed, I entered once that green bar had broke it at the bottom, and then it went down, but I stayed in it a little too long. So that was the bigger loss for me.
Right, I get it. So let me tell you something. This trade right here, you don't want to take. And the reason being is because you don't have confirmation from your larger time frame momentum. Right? Your momentum is up on this. So you're going completely counter trend at this point. Does it make sense what I'm saying? So you're going completely counter trend. So that's a trade that trade right there, you're going to lose on 9 times out of 10. And the reason being is because it's in a strong trend and momentum on your larger time frame. And in this particular case, we talk about it all the time, but this is an ABC pattern, a literal ABC pattern on your 900 to go back up. So when it broke down to below that low, that's why it shot up on you, and that's fine, well and good. So, all right, and then give me your last 2 trades. I know you had 2 more.
2 more, yep. So this next one, let's see. This looks like 10:47. Let's make sure. Let's see. So this one I went, and I know it had already made a move to the upside. there, if you the crosshairs at 10:41:28, there was a little pullback right there, and I entered in on it, and I made a little bit on there.
Yeah, so see what you're doing is you that first trade you took of the day was perfect. You took another one that was perfect too, but a lot of these, what you're doing is you're mixing them, and that's normal, right? That's normal. That's normal learning behavior. So, but what you have to do is you have to make sure, like this trade, there's nothing wrong with this trade if you're taking it on a different time frame, because your momentum and both your short term and your long term momentum's up. But what you want to do is, if you're looking at it, right, you want your moment, like the momentum's up here, trend is up here. Now you can enter in on, see if you enter in right here, now that trade becomes a winning trade. Does that make sense what I'm saying? Like this trade becomes a winning trade and you can hold on to it and add to it.
Yeah.
If you're in it right here potentially. Right. So that's potentially what that is. But that's nothing. I mean, you won on a trade and your reasoning I can see was sound. It was just not for the same time frame. The reason I say I know because I see what you're doing. You got the momentum. Both momentums on this 900 is up, and they gave that little poke bar there. I see exactly what you did. So you don't want to get them. You don't want to get them confused, because if you're entering on the 300, the trend on the 900 has to be up, and your next largest time frame, the momentum has to be up. So your trend has to be, it's momentum, trend, and timing, right? That thing got nasty quick, didn't it? So that being said, and one more, what's the other one?
I think the last one is I think I did good on that one because I got 10 points on that one. So this one was at 11. I think this is 11:12. Let's make sure. Yeah, afternoons. 11:12.
You went long or short?
I went short. At 11, if you look at 11:32, if you put your crosshairs there on the 900, it was that red bar pullback, and it once that next bar printed and broke that low, I entered and I got 10 points on it.
So I see what you're doing, and there's nothing wrong with it. In this particular case, the reason why you won is because your short-term momentum was going down, and it was coming down from the ABC pattern on that 8100, right? So I know you don't know all of that yet, and I know you just literally doing what I literally just put you out there to do. So I get it. So not a bad situation. Some of the trades were not as laid out as they should be, but this particular, I mean, this is a trade right here. That's a tough one, right? I can see how you would have took that trade. I can see how you would have took this trade because the momentum was red, and the short term and long term momentum were red at that point, but the bar probably hasn't closed.
You got a short right now on the 300 coming up off the ABC pattern.
All right, cool, Keith. Hold on one second. And I just wanted to make sure we got these in to have this conversation before Quentin had to leave, because I know Quentin said he had to leave at 12 o'clock his time or 11 o'clock his time. So I wanted to make sure we got those in. So in case there were any other questions, oh my goodness. Right there, Keith, we missed it.
Yeah.
Yeah, that was fast. I came, it was gone. Wow. That sucks. That sucks, the big one. Okay, so are there any, now Keith, go ahead and go with your questions. The reason I wanted to make sure Ronald got all those in before Quentin got going. So what time did you have a question, Keith?
Oh, it was good. When the entry on the 900 didn't have arrows, so I was asking, I was just trying, I was asking how was he entering on a red? Was he using a red bar break, or 3-bar reversal, or two? What was his entry strategy on the 900 when he entered on the 900? Because you didn't get the arrows on the 900. You only get the arrows on the 300.
Ronald, can you answer that for him?
On which trade?
It don't matter, all of them. Just what was your entry for? I'm assuming you didn't
Well,
say all of them.
like, let me see. I'm trying to. So when I was going short, what I was looking for was, like, if I'm going short, like I'm looking for a bar to what I wanted the trend and the momentum to be down. And I was looking for a bar to, I guess, fake like it was going up and turn red. And then once the following bar that printed broke the low of that bar, that's when I would enter. But I was also kind of looking at what was going on the 8100 chart as well. So I was only looking at those two charts.
Yeah, I understand that.
But I guess ultimately, once it was time to enter, that's what I was doing short and long. I would look for a bar to fake as if it's going down and then turn green, and then the following bar breaks the high of that bar, trend and momentum up, and just looking for specific things on the 8100 chart as well.
Right.
So I was trying to, I guess, essentially I was been scalping, and I wanted to get some feedback to see what I needed to whatever I need to correct.
So yeah, so I'll show you. I showed you, kind of in a fast fashion. Because I wanted to make sure we got it all in for Quentin. Just give me 1 second. Let me go on pause for a minute. Give me 1 second. I'm gonna go ahead and we're gonna go through it and show you exactly what it's supposed to look like. Okay.
I'll go ahead and go on mute, guys, so I can prep for this video call.
Okay. Cool.
All right.
All right. So let's talk through this really quickly. Ronald, I'm gonna show you. This is what your trade should look like 100% of the time. Right. First of all, you should have a red bar. If you're going short, the bar that's already printed. And ladies and gentlemen, let me start over, okay, for anybody who's listening on YouTube. All right. I'm going to teach you how the 3 chart system looks and what you should look for. And this is anything you're trading, right? You have to be able to find out the time frames that work best for the particular market you're trading. And you also have to find out what settings for your momentum works best for the differentials that you will trade, right? Because everybody's differentials may be different. But the concept is still the same. All right, so you have a red bar, and then we have momentum down. Momentum is down, signified by the short-term throw or the short-term momentum. Once momentum is now down and you have a red bar, now we can look to take the trade short. Once we get a market structure pullback, you get that market structure pullback, there you have it. That's the trade. 100% of the time. That's for a long. I'm sorry, that's for a short. For a long, it's the direct opposite, right? You want momentum to be up, short-term momentum to be up, right? And then once you get that up and you have you have a bullish bar, right? And if it retests the bottom and it fails, when you get the arrow up, take the trade. It literally is that simple. That's all I ever do, no matter what I'm doing. That's the basic concept behind how we trade. We didn't take any trades live for YouTube today because there weren't any trades that I would recommend for a group, that I would recommend from a mass scale. We might have taken trades individually, right? But from a mass scale, we don't have a situation where we have trades. And let me show you why I say that. We just now are going to the downside. Well, we had a down bar, and I really was going up into resistance. If you look on this daily chart, you can see where it kind of went to resistance and it's just pausing. Then now it broke down below. It broke down below the low today at 65. So I was like, so I'm expecting this thing may try to turn over. I can't say that for sure, but it looks like it may try to turn over, and we'll see. And that's what I have thus far. Ooh, this thing is tough. This thing is tough. Tuffy McDuffie to the downside, guys. Are there any questions? I was waiting to listen to see if I was going to get any questions.
No, that's pretty good.
So I mean, it's just a matter of wow. Wow. So now we just wait. Ladies and gentlemen, we'll go ahead and call it a day for today. Today was a good learning day. But we'll go ahead and call it for the room on YouTube. And if you guys have any questions, you know where to reach me. I'm at support@theprofitstalker.com. And please like, share, and subscribe. We do this every day. All right.